Well, today we have Adam Burrows with us. Adam is a co founder and managing director of Range Ventures based out of Denver, Colorado. Before being a VC, Adam was an operator and has been instrumental actually in building some of the most successful tech companies in Denver, including Home Advisor, where Adam was a senior vice president and part of the executive team that took the company from 100 million to $1 billion in revenue and took it public in 2017 in Colorado's largest tech IPO. He also was involved in Guild Education, which is actually a proof company, as the first outside C-level executive hired. And Guild helps employers provide tuition-free education and upskilling to its employees. Adam started his career in business strategy at BCG and is a graduate of Harvard Law School and the University of Michigan. Adam, thank you for joining us today. I would love to maybe start with having you tell us a little bit about Range Ventures and what the fund is about, how you started it, and the strategy.
Absolutely. Well, thanks so much for having me. Really appreciate it. Um, Range Ventures, we are a seed fund focused on backing the best and most ambitious founders in the Denver area or greater Colorado. We started the fund in 2020. We're on our second fund. My partner, Chris Erickson, and I started the fund in 2020 after both having careers as founders and operators. So you heard my background. My partner, Chris, was a founder of a company called Apartment List in San Francisco, took it from zero to over 100 million today in revenue and growing. And we had seen, and I had lived through the last 15 years of the tremendous growth of the Colorado tech ecosystem. I mean, we are really, along with Austin, really the solid number 5 and 6 ecosystems after the top 4 coastal ecosystems. And that has grown tremendously before COVID. And then COVID just took, I think, both those ecosystems to the next level in terms of all the tech talent from the coast that are migrating there. We saw this in Colorado. We saw really a lack of early stage capital in Colorado, and specifically really a complete gap in terms of people who were GPs and investors who had real experience founding and operating companies at scale like Chris and I did. And we looked around and we said, wow, there's a huge talent aggregation here. There's a huge desire for founders for some of that money at seed by folks who'd been there and done that. And then a desire by everybody else in the community to really get behind that next generation of companies. And so all that came together. We launched Range in 2020 and have been off to the races ever since.
Tell us a little more about the ecosystem. Why are people starting to move there? Is it lifestyle issues? Obviously, Colorado is a great state with a lot of outdoorsy lifestyle and great weather and all that. So, talk to us a little bit about that. And there were dislocations during the pandemic when people were leaving big cities. Is that part of it? And how do you kind of build the ecosystem in Colorado?
Absolutely. So we came up with the idea for the fund and really started it right before COVID. I mean, we went out to fundraise February 2020, late February 2020, which was terrible timing for fundraising for a new fund, but I think speaks to what we saw as the trend and the thesis already around tech talent that had moved and aggregated in Colorado. That thesis, just like a lot of things, such as moving to remote work and all this, were secular trends already in place, just got accelerated dramatically by the pandemic. So people moving to Colorado, I mean, couldn't have hoped for better turn of events in terms of that existing trend already accelerating. But the reason people were coming here pre-pandemic, people have always been moving to Colorado, but it was slowly really accelerated on the tech side in the last 5 to 8 years for a few reasons. I think one is just millennial sensibilities, generally speaking, wanting access to the outdoors. Boulder was where all the tech action was 15 years ago. Boulder's continued to do great, but really the center of gravity here is firmly and definitively Denver. If you look at the deal flow that we see, it's probably 80-20 Denver versus Boulder. And if you were here a decade ago, it probably would have been the opposite. And so I think, just the move to cities that are, not New York, not San Francisco, still have all the great stuff going on that you want from a food and, music and culture perspective, but are a little bit more livable and a little bit more affordable. Although that's changing, changing now as people have moved here. Denver's really been a beneficiary of that. And then, we've had the right kind of, I think, political and economic climate too. So, we're a blue state, but we're not California blue. We're a very business friendly and business minded blue. And that's really appealing to tech workers from San Francisco, tech workers from New York, who, I think just given the political climate and sensibilities, that's really appealing. You look at who our last 2 governors have been. They're both successful entrepreneurs. Our current governor was a co-founder of Techstars and a multiple time successful tech entrepreneur. So I think just all the conditions have lined up for this to be a really appealing place for a lot of tech talent to migrate to.
Do you think Coach Prime has had any impact on particularly younger generations wanting to move to the area?
It hasn't hurt. I've heard that it's definitely helped CU's recruiting, and so that'll
Right.
hopefully help seed the next generation of founders, 5, 10 years down the road.
Uh-huh.
So definitely
Yeah.
exciting time to be in Colorado in a lot of respects.
Yeah, the applications I think were up like 40% this year or so, which is crazy.
So do you guys only invest in Colorado-based entrepreneurs, or what's kind of the geographic focus of the fund? How do you think through that?
Yeah, so we're about 80% Colorado companies. We are focused exclusively on looking for Colorado companies. But as you all know, and anyone who's in VC, by virtue of the activities we're doing here, we make great connections with other investors that operate elsewhere, other entrepreneurs who are involved with companies here but are living elsewhere. And so, if we have unique access, insight, and reason to look at a company elsewhere, we'll do it. And that for Fund
Right.
One was about 20%, and expect similar for Fund Two.
What do you think are the key factors that it takes for an ecosystem to properly develop a venture community? What are the most important factors that go into that?
Yeah, I think you need certainly some folks that are really well positioned to go kick that off. So here, a ton of credit goes to Brad Feld and the Foundry Group, who really put Boulder on the map 15, plus years ago, and then Techstars in 2008, which got launched in Boulder. I think both those things were huge in just getting eyeballs and credibility for Denver and the local ecosystem. You obviously then need to back that up with real companies that get produced, that attract capital from the coast, that ultimately have successful exits. And we've had some of those and have a bunch more in the pipeline. We've got, one of the companies here is going to IPO in a couple months, which is going to be a big deal. We've had a steady stream of exits and unicorns over the last couple of years already. And then you just need the talent. And so one of the things about 10 years ago, I remember, was the topic that everybody talked about here was, hey, we've got a bunch of really good stuff happening in the ecosystem, but as companies scale, do they have the talent here? Can they attract that CMO, that chief product officer? That conversation, basically, haven't heard that for the last 5 years. Like, that's been answered. And if we don't have the talent here, which we do, it's very easy to get people to move here. And that question that somebody asked 10 years ago, well, your job seems great in Colorado, but if that doesn't work out, what else is there for me to do? No one asks that question anymore.
Are you a skier or a snowboarder?
I'm a skier.
And what's the skier? Okay. And so what percentage, since you are based in the area, of your offsites have to deal with skiing or snowboarding?
Well, it's funny. I'm telling you I'm a skier, but if anybody in Colorado asks me, are you a skier? The answer is absolutely not.
Really?
You'll know if you live in Colorado, if somebody says, do you run? Do you ski? Do you bike? The answer is no, unless you're an Olympian. Okay. Because
Okay.
next thing you know, you'll get asked on some trip to do something way beyond what you're comfortable or capable of doing. So that's just between us that I'm a skier.
Moguls and other things. Yep. Got it.
Exactly. But
Have you tried
there's great events here. I actually was just in an event for a local wealth management firm up in Steamboat, and it's really an awesome thing we have in Colorado to get together and people to bond over being outdoors and activities and not just drinking.
Yeah.
There's always some drinking too, but
Of course. I mean, those two things kind of go hand in hand, right? I would imagine though that you can't really live there without doing like one or the other, or that population set is relatively small,
that's
like
right.
sub 10%.
That's
Yeah.
right. It's the great equalizer. I mean, everybody here enjoys the outdoors in some respect, whether it be hiking, skiing, biking, whatever.
Yep.
Even in a light basis.
The irony of the whole situation, though, is that Foundry has recently announced they're not raising another fund, and so it's the ecosystem is growing, and I guess that's obviously personal issues and reasons, and I'm sure they have their reasons, but it's kind of ironic that the fund that really put Colorado on the map is kind of terminating. I don't is that what's behind that, and do you think that makes it easier for you to find opportunities, harder? Like what do you think it means?
It's interesting because that was announced, and then also recently Techstars announced that they were pulling out of a lot of kind of I think all markets except for their top four, and then where they have sponsorships, and they're moving their headquarters from Boulder to New York, even though they still have 65 people, and they're moving actually that office here to Denver. So there's been a lot of discussion here about it. The irony of it is, to your point, like those things happen. If that happened 15, 12 years ago, ecosystem would have been decimated. Here, now, doesn't matter. Like literally, it doesn't matter.
Yeah.
We give a ton of credit to both those organizations for kind of planting those seeds, but the ecosystem has grown up so huge around that those entities weren't impactful anymore. In fact, Foundry Group for about the last 5 years has been, really a non-entity locally. Certainly like important and great, nationally, and they have a fund-to-fund models and kind of investing nationally, maybe even globally. But in terms of like the real local prominence they used to have, hasn't really been that case for 5+ years. And those guys have been really successful. We know them. We're friends with them. They're LPs in our fund, actually, and supporters of Range. But they, earned the right to kind of go out on their own terms. I think they always, had said publicly they didn't really want to build this big legacy firm, and that's all there is to it. Those guys have earned the right to do that.
Yeah, for sure. It's interesting that you went out with a geographic focus as a primary strategy, and that was kind of the usual modus operandi of funds outside of Silicon Valley. Hey, I'm going to focus in the Southeast, or I'm going to focus in Boston, et cetera, et cetera. And now it's almost like the opposite. It's like I'm focusing on this specific sector because it's important that I know all the companies, wherever they are, et cetera. So talk a little bit about that, how you thought about that, how the LPs received it, and how it helped you or hindered you in your fundraising or in your business growth.
Well, it's a great question. We thought, 5 years ago when we first had this idea that in a high level venture was going in a direction where there's two groups that would be successful. One would be, the top 5-10 branded firms that are multi-stage, bigger and bigger, the Sequoias, the General Catalysts, et cetera. Those firms are going to do really well because they've got the brand, the resources, and the firepower. And then there was going to be a real kind of big group of niche players by whether it be geography, whether it be by vertical, that can be systematically kind of advantaged within whatever small pond they're looking at, right? And can size their funds right such that there's more than enough opportunity within that pond so that they can be great returners on their own. We took that approach, certainly, and we thought that both the vertical specific and geographic specific are important. We actually love partnering with vertical specific funds. So we've done this a lot where we co-lead around. We're the geographic specialist, they're the vertical specialist, and whatever that vertical is, and we kind of play quarterback and bring those folks together. One of the things we've heard, and I think people academically look at this and say, hey, big LPs, hey, geography doesn't matter anymore. It's all virtual. It's all, post-COVID, who cares? I think that's right in some respects, but in some respects, it couldn't be more wrong when you're living this on the ground. We've had so many incredible founders that have moved here in the last couple of years. And what they all have in common is they've all chosen to move here. They've picked up their families, their businesses, and they say, hey, I've looked at different places. It's almost usually I look at Austin, I look at Denver, and I move to Denver. And I'm sure the people in Austin say, I looked at Austin, Denver, moved to Austin. Pick moving to Denver. I don't really know anybody here. Maybe I know one or two people, but I'm building my company here and I want to be part of this local ecosystem. In fact, I feel more connected to it than wherever I came from because I chose to be here, right? Yeah. I picked this place out of anywhere I could pick. And so those folks actually we found are have even a higher desire to be connected locally, right? When we have local founder dinners, they're the first ones to say, count me in. Can I come to another one, right? Who else can you introduce me to? And so we think geography is super important. It's proven to be the case. I mean, our win rate among companies that we've wanted to invest in competitive rounds is, I would put it up against any fund in the country or any fund in the world. And that's because we pick our lane, right? We are very specific. We're not a Rockies fund. We're not a middle of the country fund. We're Colorado. We're sized appropriately with an ecosystem that can have incredible returns, and we're systematically advantaged here.
Is there vertical concentration in Colorado? And then the kind of secondary question to that, are there certain verticals that you specifically like to focus on?
Yeah. So what's cool about this ecosystem is it is pretty broad and pretty diverse. That said, I think the bulk of opportunities that we see here are B2B SaaS so far. Mm-hmm. You've got a legacy of some really successful companies here, but we've had successful consumer companies. There's a really exciting burgeoning aerospace and robotics communities here. You've got a pretty awesome cybersecurity community here. It's reasonably diverse. There's also actually, and this is not an area we play in, but there's a huge natural foods ecosystem as well. So it's one of the things I think that's great about Colorado is the diversity. We're not really dependent on any one sector.
Do you want to maybe give an example of a portfolio company and talk to us about how you found them, what space they're following, and how Colorado has helped them in a unique way, or you have helped them in a unique way?
Yeah, sure. I can talk about, we were talking about before this podcast offline, one of our more recent portfolio companies in Fund 2 called Magic School. We led their seed round in August. They're in Denver. And the founder of Magic School is a first-time tech founder, but second-time founder in that he founded a public charter school, high school in Denver, that was the top performing public charter high school in the city. Former Teach for America guy, former teacher, principal, et cetera. Really impressive leadership qualities, knows ed tech and education as well as anybody. And he started a company called Magic School, magicschool.ai, that's providing tools to help save teachers 10 hours a week in efficiencies. That company has done incredibly well just out of the gates and is off to the races selling to both teachers and school districts. But one of the things that we did actually was we connected, Adil Khan is the founder's name. We connected him pretty early on as he was looking for a founding CTO with one of our LPs. And that gentleman's name is Todd Tobin. He was the co-founder of a company here called Craftsy that had a successful outcome to NBC a number of years ago. And so that's exactly what we want to see is we want to see people that built that experience in Colorado's ecosystem before now go to that next company to have an even bigger outcome, right? An even bigger outsized impact on the ecosystem. And so that's what's going on with Magic School. Super exciting story.
What do they do exactly? What give us an example of a use case?
Yeah, so teachers have to do a lot of mundane activities in their daily practice. That's not just teaching kids. So think about lesson planning being a big one, writing up individual education plans for students, creating rubrics to grade quizzes, that sort of thing. And Magic School uses AI to make that all a lot simpler for teachers.
What do you think are the most important characteristics to being a successful founder?
We love founders that really have what we would call an earned insight, right? Otherwise known as founder market fit. Somebody who just sees and has experienced the problem they're trying to solve and knows in their core that there's a better way and that the future is going to look different than everyone else thinks and that they know how to solve it, right? We love founders like that who we say are the company's best salesperson. That doesn't mean they're going to run sales or have a sales background, but what it means is they're fearless, they're compelling, and they can tell their story in a way to attract investment dollars, they can attract talent, and they can attract early customers, right? One of the red flags, and we had this happen pretty recently, are when we jump on a fundraising call and it's a founder and then their head of sales, and the head of sales is the one doing the company pitch, right? That's going to turn us off.
Right. What are some of the other red flags? Let's go the opposite end.
Oh, great question. One of the biggest red flags lately that I've been talking about is when founders can't articulate the context of what they're doing, right? So they have their idea, they tell you what they're doing, but they can't really tell you the why now and also the why them. So they might be operating in a really crowded space and they might not even be aware of some of the other big competitors. They might not be aware of the big flame out that happened 2 years ago that raised a bunch of money and didn't work. And it's all well and good for someone to be operating in a crowded space or to be following a bunch of failures, but you got to know why they failed and why you're doing something differently to succeed, not just, hey, I thought of a great idea and that's why it's going to work. We see that a lot. We see that a lot.
Yeah. What's some of your additional advice that you might share with founders, when they're getting ready to pitch investors?
Yeah, I think a couple of things in terms of advice on that. One is we always say too, Chris, my partner, calls it 8 miling yourself. If you remember that Eminem reference, which is
obviously he doesn't.
No, in your pitch and in your deck, even we tell founders do this. Think about what's the thing that investors are going to pick up on and pick at on your business. What's the thing they're not going to like or they're going to be concerned at right away, and basically take that on yourself so you own the narrative, right? Don't hide it, don't obfuscate it, don't act like everything is perfect. And founders do that a lot because they know I got to sound confident, I got to sell my business. And I tell them investors are trained to poke holes and to find the thing. Better for you to tell them what that is and own the narrative. It shows that you're really in control and gets them thinking about where you want them to think about and not leaving it to their own imagination of what's wrong with this business. So that's one of the big pieces of advice that we give.
That's great advice. No, and you, because I read it, you wrote a blog post somewhat recently, although I don't remember the exact month, but saying that the most important rule still matters, which is not just applicable to founders, but really applicable to investors alike and basically everyone. Do you want to kind of go into what the most important rule is?
The most important rule is just the golden rule. We're all taught when we were in kindergarten or preschool. And it's amazing how few people I find follow that. And that's just, act towards others how you want to be treated. And for us, that means one of our core values at Range is we do what we say we're going to do, right? If we tell a founder we're going to follow up by next Monday, we follow up by next Monday, right? We never ghost anybody. And so I think it's amazing. And I've been really surprised at how just doing that, I think, puts you in the top 20% of investors in the minds of founders.
Yeah, I was recently meeting with another partner from a VC firm on Monday, and we got to the discussion of what is happening, the trends, et cetera. And he was making the point that a lot of the kind of VC tourists, he called them, people that didn't have experience, didn't have any business being VCs, but maybe had access to some capital, left the market. So it's now kind of back to basics, and talked about how the most important thing is being honest with the founders and giving them the truth and telling them what maybe they don't want to hear. So do you want to talk a little bit about that, and what are some of the, talk a little bit about the current market, and what are some of the toughest lessons that or the toughest messages that you have to give to entrepreneurs?
I love to hear that, Thanasis, because that's something that I think needed to happen. I don't think it's fully all happened yet, but we have seen and been frustrated, I think, over the last 4 years at how many what we call VC cheerleaders there are, right? That no matter what the founder is doing, it's you're doing great. And then if the founder is not doing great, they just disappear.
Yeah.
Avoid confrontation, right? And I understand why, because there's this massive incentive, and there has been for a number of years, to be seen as founder friendly at all costs, right?
Right.
I don't think that lying to founders or being a cheerleader as you watch a founder run into a wall and ultimately probably lose their business is founder friendly, right? It's founder friendly in the short term. It's the opposite in the long term. And we think of ourselves as founder friendly in the golden rule sense of how did we want to be treated when we were on the other side of the table?
Right.
And we didn't want to be lied to. We wanted to be, we wanted thought partners who were honest with us, right? It might mean that we debate. We might have an active debate and discussion, and we might even disagree. We might not even take their advice, but I still want the advice. I think that that's super important. And I think that people are seeing, investors are seeing the importance of who you syndicate your investment with.
Yeah.
And before, I think people could overlook that because, hey, things were all up and to the right and money's money. Now, when companies are going through tough times, we all see who else you want around the table, and it matters.
That is so true. And we've been in the business for a few years, and it's kind of like, oh, experience doesn't matter. Everything is going up and to the right. But when the market turns, that's when experience comes in handy. And sometimes, that's where you can help the founders. And so I was curious as to what your perspective is on number of VC investors on the board or involved actively in the company. Because one of the other things that I've seen is sometimes when you have too many, it's almost like everybody's trying to add value. Everybody's kind of gingerly walking on eggshells, and nobody wants to communicate anything real until things get really tough, right? So have you seen something, it's a dynamic like that?
That's a great point. Yeah, I have. And it's really a fine line between, I think on one hand, having a lot of investors, if you pick the right ones, you just expand your network, right? At Aperture, if you're a founder and you can manage them appropriately, when you send out that update to your investors and you say, hey, I'm looking for a connection to XYZ company, it's amazing. I've seen, you never know where that connection comes from. We had one company, literally the smallest individual investor on their cap table, right? The $5,000 investor was the one that made this incredibly key customer introduction that nobody else could. So having a lot of connected people helps. On the flip side, you're exactly right? Too many cooks in the kitchen. So I think that's on the founder to manage that appropriately.
What are some predictions for the remainder of the year?
I don't predict anything macro. Anybody who does is lying that they can forecast, because what's the macro prediction everybody gives is basically like more continuation of the same trend.
Right, of course.
And inevitably that trend stops, whatever that looks like. So I don't predict macro. What I will say is I think there's a lot of zombie companies out there, right? I think there's more than maybe people, we all probably see it and recognize it, but I think folks outside of our industry directly don't realize how many zombie companies out there. And I think there's a long tail over the next couple of years to work off of companies who have been bridged, extended, kind of kicked the can, and something's got to give. They're either going to have to go recap, go out of business, sell to private equity or to a strategic for less money than the investors have put in. And I think that's going to take a while, and it'll be interesting. I don't know exactly what implications that's going to have. But it's just a phenomenon that I think everybody's got to be aware of over the next few years. I think there's still a lot of talent that's kind of being kept at these companies, collecting a paycheck who really aren't going anywhere over the next few years.
Yeah, I think there's going to be a massive bifurcation between the great companies and then everyone else, right? So, what about when it comes to VC funds? Obviously, there's been a massive rise, to Thanasis's point earlier, in the amount of VC funds in the mix. What do you think? I know that you don't make macro, crystal ball predictions, but what's your kind of philosophy on that?
Yeah, I mean, it's amazing. You see some of the articles that have come out recently, I think in the last couple of weeks from PitchBook and others talking about the number of funds that haven't, first-time funds that haven't successfully raised second-time funds. And I think that's real. I mean, we were, our fund is still open. We were fundraising over the last year and are fortunate to be in a pretty good spot there. But it's tough. It's tough out there, right? Fundraising was really challenging. I've talked to a lot of others that haven't been as lucky as us, and it's tough for everybody, right? It's tough for everybody, and it makes sense why. There just hasn't been liquidity coming back to LPs, so they're just not able to make new allocations, regardless of how much they like you. And so I think there's just going to be less and smaller VC funds for the next few years.
Talk to us a little bit about your personal background. Like, how did you get into business? Where did you grow up, and how did you kind of decide on VC? And how do you feel now that you've been a VC for a few years?
Well, I grew up in Des Moines, Iowa, which is the hotbed of tech talent. I joke, but who I carpooled with to fifth grade soccer was Ben Silverman, the CEO and founder of, not CEO anymore, but founder of Pinterest. So yeah, there was something in the water that year a little bit. I don't know, not for me, but for Ben for sure.
Well,
So I grew
early
up in Des
on,
Moines,
actually,
Iowa.
he didn't. I mean, early on in Pinterest, a lot of the users were actually middle of the country people
I
that
think
were
that's
doing
right.
scrapbooking. So perhaps some of those insights that he picked up helped him, right?
That's right. I like that. I like that narrative. We'll go with that. We'll find maybe the next great entrepreneur in Iowa. But yeah, grew up in Iowa. As you said, went to University of Michigan. Then I went to Harvard Law School. Realized there that I didn't want to practice law. I was definitely more inclined towards just the business side of the world, just how my brain worked. And was lucky enough to kind of be able to skip practicing law and go right to Boston Consulting Group, where I got what I consider my advanced MBA. Had literally never used an Excel spreadsheet before I started at BCG. So amazing they let me learn on their dime how to do all the basic block and tackling there. And then was there for a few years. Found an opportunity out in Colorado that was very exciting to me, which was a company called Service Magic. Ultimately, it was a turnaround that we, new team came in, we turned into Home Advisor, had just an incredible run. Super, super lucky how that worked out. And I've always been the kind of person, Thanasis, who was more mile wide, inch deep than just going super deep on one area, right? That's what attracted me to consulting, where you get to work on all kinds of different industries. It's what attracted me to my role at Home Advisor, which ultimately became corp dev, running corp dev, where I got to see every company in the local services industry over that time period. And then we bought a handful of companies. I had a portfolio of those emerging businesses and founders that I got to manage. And I loved being able to context shift between completely different businesses all day, every day. So knew that this is the kind of thing that I wanted to go do in venture. And then just given the growth of Colorado ecosystem, given my experience set and network I'd built, and then ultimately partnering with Chris was really just the perfect combination of all the factors coming into place to allow me to go do this. And have really, really enjoyed it. Really enjoyed it since, as I kind of alluded to, fits my personality really well. It's been an exciting time to be in Colorado. I love the psychological challenge of investing. I've always been a student of investing more broadly. And so just love the constant learning and chess game that investing entails.
And at the very early stages, it's more about like really looking at the people involved, right? So there's an idea, obviously there's a market, and you're assessing the value of that idea, but it's about the people. Can you tell us a little bit about how you think about that aspect of things, where a lot of it is about assessing like the founders and what how you approach it during the kind of courting process and the fundraising process?
Yeah, it is all about the people at the early stage. I mean, it certainly the business and the market, matter also, but from a pecking order standpoint, I think people are number one, especially at the early stage. I actually really like investing in this time with regard to people, and I'll tell you what I mean. So I think it was Frank Rotman from QED Investors, the big fintech investor, had some comment. It was about a year ago, in the market was really kind of starting to turn south for tech a year and a half ago. And he said, in 2021, it was enough to be a founder that could solve a problem. And now you've got to be a founder who can solve a problem and build a great business. And that fits much more with what Chris and I have always been attracted to and look for as former operators ourselves, that operated companies when things weren't, 2021 frothy. And that's what we look for, right? We look for founders that not only we feel like and people that, have that earned insight, have that great solution to an existing problem that they felt, but really like, is this the kind of person that can build an awesome business, right? Is this the kind of person that can spot talent? Is this the kind of person who is intellectually curious, intellectually honest, right? Resourceful, tenacious, all those dynamics that involve that, are needed to go build a great business versus just having some great insight and being able to tell a great story. That's not enough anymore.
All right. So moving on to our 4 standard question segment, we're looking forward to hearing your answers. Our first is our NVCA question. So the National Venture Capital Association advocates for public policy that supports the venture community and the American entrepreneurial ecosystem. If there is one thing that you would change about the venture capital industry or one policy that you'd advocate for, what would it be?
Yeah, this is an easy one for us as a small fund. I would eliminate the 99 investor limit for accredited investor funds in order to be exempt advisor. I think it's really just a tax on small funds, keeping us small and making it more difficult for us to operate. So like a lot of funds, we have a parallel fund so that we can have more than the 99 LPs. It just creates a bunch of unnecessary admin overhead and cost. And there's really just completely no reason for having it.
We hear you on that one. Number 2, and I think our personal favorite, if you weren't a VC investor and money wasn't a concern, what career would you have?
Yeah. So if I had different genetics, I'd be a pro golfer. But unfortunately, my golf game will just never come close to doing that. I don't know. I think if money was an object, something that would be a lot of fun would be to be maybe a baker. And I think of this because I have 2 young daughters and we've gotten really into baking things together. It's a lot of fun. I have kind of an analytical, exacting brain. So baking is perfect for that. And I love to eat.
That's a great father-daughter activity. So what do you guys bake?
Well, the most complex thing we baked, which was really an accomplishment, were croissants. So I had no idea, for those of you out there that have done that, what lamination entailed. But it was quite the activity undertaking. They came out great. But I think I'll stick with kind of the standbys of, just basic cakes, pies, waffles, pancakes, muffins, all that good stuff. A lot easier.
I'm going to make it obvious that I'm not a baker. Is that made with phyllo dough, right?
With croissants? No. With a lot of butter. So that you get that same thin, crispy.
Because I thought it had I thought it was like super thin. So then what is it made with?
It's just its own flour, but lots of
butter mixed into the dough, right? Yeah, I've been watching Jacques Pepin. I don't know if you know. He is a well-known chef, and he's on Facebook. He has all these short videos, and his recipes are very, very simple. So it makes it almost like approachable, right? Like it's not one of these fancy. So that's awesome.
I watched Nailed It, so I feel better about myself on Netflix. So it goes to show you I'm not a baker. Okay, number 3 is, who is someone that you look up to and why?
So in the VC industry, I've always looked up to Bill Gurley and really listened to everything that he's ever put out. Had the opportunity to meet him a number of years ago. The reason is, I think he self-described says that he is an investor first and a VC second. And I've always thought of myself that way too, whereas I think a lot of VCs lose the broader context of investing principles, psychology, and just narrowly think about VC. But we're just one asset class with a lot of the same investing dynamics that any asset class entail in your own psychology of when to buy, what price, think about selling. And Bill, I think, is always provides a sober-minded perspective on all of that.
Did you watch his most recent speech at the All-In conference about regulatory capture in AI?
I did. Yeah, regulatory capture has been one of his big soapboxes more broadly over the last few years, and I think he's right on.
Yeah, great speech for whoever hasn't seen it, about like the strong how regulation really basically helps incumbents. Back to the earlier point where you made about like limiting to 100 investors. Well, who does that hurt? Really small investors, small funds.
Yeah, that's right. In that case, right, I'm a big fund. I'm a multi-billion-dollar fund that's got all these huge, multinational corporation LPs or pension fund LPs or whatnot. And my biggest fear would be somebody goes bottoms up and aggregates, 10,000 small investors and gets just as big as I am. So regulation obviously helps keep them entrenched. And it's the same across a lot of industries, as Bill points out.
Number 4 and final is, what is the best piece of advice you've ever received?
Best piece of advice I ever received was in the context of a career search. And as a VC, we meet a lot of folks who are transitioning in different, looking for their next roles. So I give this advice a lot, which is simple. And sometimes the best advice is so simple. It's do whatever sounds good at the time, right? It's amazing how many motivated, ambitious people, they're looking at their next career. They've got their, pros and cons list. They've got their spreadsheet. They've got all the analysis around which job, what kind of thing they want to go do, where it's going to lead. It's like, no, throw all that stuff out the window. Just what sounds fun, right? Because if it's fun, you trust yourself, you're going to be excited to get out of bed to go to work. You're probably going to do better at whatever you're doing. And it's ultimately going to lead to a more successful and fulfilling outcome than, analyzing your way into it.
Right. Exactly. It's great advice.
Adam, thank you very much for joining us today. We enjoyed learning about you, your background, and Range Ventures. Thank you very much.
Yeah, thanks so much. Really appreciate the time.